In this case, this stock pays me 26.78% every year. Now, how did I get that? Well, I took the price I paid for each share. I divided that into the yield and I multiplied by 100. I'm earning 26.78% on this stock every year. Hello, I'm Chip Stites. Every week we have a new video, sometimes two. And often we answer questions that we are asked on a pretty regular basis. This week's question is, what's your favorite stock? It's an interesting question because I don't have a favorite stock. I have a favorite process for finding stocks. I have favored results. I have some stocks that I like more than others. But the thing that's favorite to me of everything is something called yield on cost. Now, what is yield on cost? Well, yield on cost is you take the stock's annual dividend and divide it by the price per share that you paid for it, and you multiply by 100. Over time, you get some very, very special yields. And I have one for you today. In this case, this stock pays me 26.78% every year. Now, how did I get that? Well, I took the price I paid for each share. I divided that into the yield and I multiplied by 100. I'm earning 26.78% on this stock every year. Now, whether the price goes up or down, that number is going to be a good number. And if you have a ton of those in your portfolio, you're doing very well and you're making a lot of money and you're comfortable and you're happy and you don't have to worry about what the market does. That's the point of all this after all. So let's take a look at what is today my favorite result. I'm going to screen share here. And we're going to take a look at, there's the 5-year chart. Now, what do we know about this stock? Well, we know that its beta, the risk that it takes against the S&P 500 is 0.59. So when the S&P 500 goes up 10%, this is going to go up 6, give or take. The S&P goes down 20, this is going to go down somewhere around 12. So it's not going to move as much as the S&P 500. It's not as risky as the S&P 500. But this stock with less movement and less risk is paying me 9.27%. And in a period of recession, regardless of what you're listening to, as of August 6th, 2022, we're in a recession. This stock is not. The stock is an energy stock, and it's paying 9.27%. And you can see here it also pays monthly dividends, which means I am reinvesting into this stock every month. So I'm dollar cost averaging. I don't have to do anything. I don't have to look at it. I don't have to follow it. I own considerably more shares than I bought. How long does it take to do this? Not long. In this case, it was created over 3 to 5 years. It's not created over 2 weeks. It's not created over 2 days. It's not making $1,000 because I made the right trade. No, this is something that's done easily over time without having to worry about it and without having to think about it. So let's look at the dividends, because the dividends are an important part of what we look for in yield on cost in any stock. We look for dividends because for retirees, especially, you want to give something, you want to give consistency, you want income coming in every month or every quarter so you can eat, so that you can have a good retirement. So here are the dividends. Now, is this an ideal dividend chart? No, it's not. It goes up and down and up and down and up and down. I would rather have something that looks like this, consistently up. It's got a payout ratio. In other words, how much of its earnings does this stock pay out? It pays out about 89.26% of its earnings as of the last quarter. So it's paying me most of what it earns. That's a good thing, especially with oil prices and gas prices today. So what else? It's got a 5-year growth rate of about 10%. That's not bad, but it goes up and down. So I'm not going to worry about it. It can afford to pay out what it's paying me. It can afford to do it monthly, and it is consistent. And that creates, over time, whether it's monthly or quarterly dividends, that creates a cost on yield, which can give you a lot less to worry about in retirement. That's why today, this particular stock and its return is something I really like. There could be others. Over time, I'll bet you that IBM or Chevron or another company will do this well, because that's the type of thing that we invest in here at the Laughing Retirement with a perpetual income engine. That's what we're looking for. Income for you and your family for the rest of your life and the rest of their lives, just like a foundation. So why don't you do that for yourself and your family? Why don't you like this video? Why don't you look at our other videos? And I suggest that you consider taking the classes that will enable you to create this kind of return in your whole portfolio. That's what we're all about here. Thank you for joining. Thank you for liking this video. And thank you, most of all, for creating a laughing retirement for yourself and your family. I'm Chip Stites, your host.